Gold is in an absolute freefall, just after smashing all-time highs, kissing nearly $4,382 an ounce. The price just created over 5% in a single day. That is one of the sharpest, most aggressive drops we've seen in years. The move was so violent it left a lot of investors completely shell-shocked, panicking and asking if this is it. Is this the start of a catastrophic long-term crash for gold? But on the flip side, a totally different group of investors is looking at this dip with greed, not fear. They're asking if this is the massive golden buying opportunity they have been waiting for. So is this the bull run rally over, or is this just the market shaking out the weak hands before the next explosive move higher? In this video we're going to break down both sides of this billion-dollar argument. We'll look at the case for a crash and the case for a simple correction, and most importantly what the charts and the hard data are telling us right now. By the end of this you will have the clear framework to make your own call. Remember, I'm not a financial advisor and this is educational and entertainment purpose only. Before we get into the crash versus correction debate, we need to put this move into perspective. On October 21st, gold prices just fell off a cliff, dropping from their highs to around $4,128 an ounce. That's a staggering 5.3% haircut in one session. So why did this happen? It wasn't just a one thing, but more like a perfect storm of different factors. First, after an unbelievably rally, simple profit taking was bound to happen. So far this year, gold has surged more than 60%. Let me say that again, more than 60% gain in less than a year. When you see returns like that, some investors are always going to cash in, and that selling pressure starts to build. Second, the US dollar suddenly showed signs of life. As a general rule, when the dollar goes up, gold tends to go down. That's because gold is priced in dollars, so a strong dollar makes it more expensive for anyone using other currencies, which can put a damper on demand. And third, a tiny sliver of optimism popped up around US-China trade relations, with officials scheduling new meetings. In the world of gold, bad news is often good news. Gold is a safe haven asset. Investors run to it when they are scared, so any hint of resolving a major economic headache can cause investors to dump their safety place and move back into riskier assets. But here is something critical to remember. Despite this brutal one-day drop, gold is still up nearly 50% from this time last year. So while the short-term picture looks terrifying, the long-term trend is still incredibly strong. This brings us to the biggest question on every investor's mind. Is this 5% drop the first tremor before a massive earthquake, or is it just a healthy pullback? Let's start by looking at the dark side, the case for a major gold crash. The argument for a much deeper crash in gold rests on a few powerful ideas, and you'd be making a mistake to ignore them. First, the most obvious is the concept of reversion to the mean. Simply put, what goes up must come down, and gold has gone up at a pace that lots of people think is unsustainable. A rally of nearly 50% over the past year means the metal was technically overbought. The bears argue this isn't just a small correction, it's the start of a much larger unwinding of that speculative run-up. They think the easy money has been made and now we're going to see a long period of selling, and as the latecomers who bought near the top are forced to give up. The second major headwind is a potentially stronger US dollar. While the US dollar has been weakening long term, short-term spikes can do serious damage to the gold price. If the US economy shows it's more resilient than expected, or if other major economies start to stumble, investors might just seek refuge in the US dollar itself instead of gold. That would put sustained pressure on the metal, possibly pushing it far below that $4,000 mark. The bears see the recent dollar rally not as a blip but as a potential change in the trend. Third, there is the sentiment factor. Gold thrives on chaos. For the past year it's been fueled by global uncertainties, supply chain messes and political drama. If we start to see a real de-escalation of these conflicts, a huge chunk of gold's fear premium could evaporate almost overnight. Bears argue that the market is currently overpricing risk, and as that risk perception falls, so will the price of gold. Finally, we have the ongoing US government shutdown. Now you'd think this would be great for gold, and at first it was, but the bears' take is that the long shutdown could lead to a market-wide deleveraging. If the shutdown starts to seriously hurt the US economy, it could trigger a dash for cash, where investors sells everything, including gold, just to get liquid. We saw this happen in 2008 and for a moment in March 2020. In those situations, gold got sold off right alongside stocks because cash was king. So counterintuitively, a deepening political crisis in the US could actually create a major headwind for gold. To the bears, this isn't a dip, it's a warning shot. The mix of an overbought market, a resurgent dollar, and shifting geopolitical winds could be the receipt for a much deeper and more painful crash. Now let's flip the coin. The bull sees this exact same 5.3% drop as not a reason to panic, but a reason to get excited. They argue this is a classic healthy correction in a powerful long-term bull market. First, let's talk about the rally itself. Gold had an insane run-up of nearly 50% in the last year, but assets don't move in straight lines. Pullbacks aren't just normal, they are necessary. They shake out the speculative froth, let the market build a new base of support, and set the next stage for the sustainable move up. A market that only goes straight up is a bubble that's destined to pop in a spectacular fashion. A market that pulls back, consolidates, and then keeps going, that's a healthy, durable bull market. The bulls say this sell-off is exactly what the doctor ordered. Second, the fundamental reason for owning gold haven't gone anywhere. In fact, they might be stronger than ever. Central banks around the world are still massive net buyers of gold. They're actively trying to diversify away from the US dollar, and gold is their main alternative. This creates a huge structure level of demand that basically puts a soft floor under the price. And while the market got a little hopeful about trade talks, the bigger picture is still one of persistent global uncertainty. The US government shutdown is a glaring reminder of political instability in the world's biggest economy. Inflation concerns haven't been solved. These deep-seated economic and geopolitical risks are the long-term fuel for the gold bull market, and a few positive headlines aren't going to change that. Third, the experts who follow this market closely aren't panicking. In fact, many see this as the pullback they were waiting for to add to their positions. Major financial institutions remain incredibly bullish. HSBC, for example, has a forecast that sees gold potentially reaching $5,000 per ounce by 2026, a sentiment shared by analysts at the Bank of America and Societe Generale. They don't make calls like that lightly. Their analysis is based on the powerful drivers of central bank demand, geopolitical hedging, and the simple search for a reliable store of value in an uncertain world. From the bullish perspective, this drop is a gift. It's a chance to buy into a powerful secular bull market at a discount. They believe the fear is temporary, but the fundamentals are permanent. They see this not as the end of the run, but as a quick breath before the climb continues. So you've heard a case for a crash and a case for a healthy correction. One side sees a bubble bursting, the other sees a golden buying opportunity. Which side are you on? Drop your thoughts in the comments below. Arguments and theories are one thing, but the charts tell the real story. So let's push the narrative aside and see what the price is actually doing. This is where the battle between the bulls and the bears is being fought, level by level. The first and most critical level to watch is the one we just bounced from, the area around 4,100 to 4,128. This is where the buyers finally stepped in and stopped the bleeding on October 21st. This is now our immediate floor. As long as gold stays above this level, the bulls can argue that the worst is over and a new base is being built. But if the price breaks below $4,100 with a conviction, that's a major win for the bears and signals another leg down is likely. Below, the next major support zone is the psychological $4,000 mark. That's a big round number that will get a lot of attention. A break below 4,000 would likely trigger a wave of automated selling and stop loss orders, potentially sending us into a rapid slide toward the $3,850 to $3,900 range, which was a key pivot point earlier in the year. For the bears, breaking $4,000 is the key to unlocking a true crash. Now, what about the upside? For the bulls to take back control, they need to do more than just hold the support. They need to start reclaiming lost ground. The first hurdle to watch is around $4,250. This area will probably act as a ceiling on the first bounce attempt. If gold can push through and hold above it, that would be the first real sign that the bulls are back in the driver's seat. But the real test, the final boss battle for this bull market, is a retest of the all-time high near $4,382. Taking out that high would completely invalidate the bearish argument and signal that the correction is officially over, paving the way for a move toward $4,500 and beyond. So the chart gives us a clear roadmap. The line in the sand is $4,100. Above it and the bulls have a fighting chance. Below it and the bears are in control. Keep your eyes on these levels. They tell you the story long before the headlines do. Is gold crashing? Well, that violent 5.3% drop was a severe shock to the system, but it doesn't look like the beginning of a long-term catastrophic crash. Instead, it seems to be a much needed, even if aggressive, technical correction within a very powerful and intact bull market. The crash case relies on the market being overhyped and the dollar staying strong, and geopolitical risk just melting away. While that's possible, it doesn't seem likely. The fundamental pillars holding gold up, record central bank buying, deep-seated uncertainty like the US government shutdown, and its role as an inflation hedge are all still standing strong. This sell-off was probably driven more by short-term profit-taking and algorithms than by a real shift in the long-term outlook for gold. While the risk of another dip is very real, especially if that key 4,100 support level breaks, the broader consensus among analysts is that this pullback is a buying opportunity, not an exit signal. The long-term trend for gold is still up, and this was a stress test, and for now the bull market has been, but it hasn't broken. The key is to stay vigilant, watch the technical levels we talked about, and not let one dramatic day distract you from the bigger picture. Navigating a volatile market like this requires clear, timely analysis. If you want to stay ahead of the market and get regular updates on where gold is heading next, make sure you subscribe to the channel and hit the notification bell. I'm here to help you cut through the noise and become a smarter investor. Thank you for watching, and I'll see you guys in the next video.